from the AI wave. I get a lot of questions about, is this just a bubble? Is it about to burst? And those are good questions because bursting bubbles are something you really want to stay away from. And I'll show you why here in just a minute. There is talk about this starting to feel a little bit like 1999. And I'm going to show you some parallels and some differences in between this market and the market back then. In the late 1990s, any company with .com in its name would attract investment dollars like crazy. A lot of people made a lot of money, but unfortunately, a lot of these companies never had any profits. Some of them never had any sales, but they all had good stories. And the term that was coined back then was story stock. They didn't have anything going for them, but they had a good story. And often that was enough to get your company listed and start attracting investment dollars. If you look at some of the leaders of the technology boom back in the late 90s, there are some similarities to today. Now, the red line along the bottom of this chart is the S&P 500, which over this 2-year period that the chart shows, gained 51%. Now, that's a real respectable return. But if you look at Qualcomm, which is the yellow line on the chart, Qualcomm was up 2,700% during that same 2 years. That's 27 times its original investment was gained. Amazon was up 1,400%, although most of that was made in 1998. The blue line on this chart shows Amazon roaring ahead in 98 and then just chopping sideways in 1999. But still, they had a real good couple of years. The other companies on that chart, by the way, would be Apple and Intel and Oracle, still big companies today. And these companies compare favorably to what's called the Magnificent Seven today, which are the tech stocks that have been leading the market for the last couple of years. And these companies are focused mainly on artificial intelligence. Now, AI, as it's called, is really nothing new. Netflix has had the ability to suggest movies that you might like they've been doing this for 20 years or more. Google has autofills your emails or your internet searches. These are all products of artificial intelligence. But the stock boom in AI started a couple of years ago with a company called ChatGPT that provided software that allowed the average computer user to access the power of artificial intelligence without having to become an expert coder, without having to sit for hours typing instructions into the computer. It became as easy as internet browsers in the 1990s, when you could all of a sudden just click on a picture or an icon and be taken to whatever you wanted to see. That was a big deal because back then, again, people didn't have to be coders to use the internet. So this is a big deal. And AI has become the mating call, if you will, of investors over the last 2 years. There's a venture capital firm called MMC Ventures, which did a study last year on 2,830 AI startups. And what they discovered is these companies, although they said they were AI, only about 40% of them had nothing to do with AI in a significant way. So those are the story stocks of today. The idea of a story stock is still alive and well, and you need to be able to determine what's a story stock and where's real value. And we'll talk a little bit about that in just a minute. Could there be a crash in our future? Sure, there could be. In 2000, we started what's called the dot-com crash, which took the NASDAQ 100 index down 82% over a 2.5-year period shown in this chart. Now, 82% is hard to recover from. The next chart shows how long it takes to recover from that. That's, again, the NASDAQ 100 taking 16.5 years just to get back to where it was in the year 2000. Now, if you tell a buy and hold investor they might have to wait 16 years just to get back to even, they're probably going to run, like crazy. They ought to. But let's look at today's market. The next chart shows NVIDIA, which is sort of the poster child for AI companies. They make computer chips that are the most powerful chips in the world. And these are what a chip about this big sells for $40,000. And companies like Microsoft buy them by the millions. Okay, so NVIDIA is making a lot of money. Their stock price is up 1,100% over the last 2 years. To put that in perspective with some of the other tech leaders, like I did for the late 1990s, these are some tech leaders currently. Now, this is a 1-year chart, and the red line at the bottom is the S&P 500, which has gained 19%, 19.32 actually, over the last 12 months. This is through September 30th. Now, the yellow line in this chart is NVIDIA. It's up 138%. Microsoft's up 27, Apple's up 12%. These are good numbers, but these are not bubble-like numbers. So this suggests strongly that we have a strong investing wave, but it's not yet in bubble territory, or may never be in bubble territory. So don't necessarily be afraid of that. The real difference right now is that these companies have more than just stories like the companies back in the late 1990s. NVIDIA, for instance, the revenue for the quarter ending in April 30th was $26 billion, which is a 262% increase. Now, most publicly traded companies are grateful if they have a single-digit revenue increase. They brag about it. Here's a company that had a 262% increase, more than almost tripled, over tripled, actually. NVIDIA's net income for the 12 months was $42 billion. That's a 700% increase from the year before. So the real story and the real difference between now and the dot-com bubble is that there's real value in these tech leaders right now. This is not a bubble that can burst very easily. The next chart shows 5 of the tech leaders of today. And in the interest of full disclosure, we do hold NVIDIA, Microsoft, and Apple in some of our Shadow Ridge portfolios. We do not own Google or Meta, which is the Facebook parent, in a portfolio, nor on any watch lists. But what I did is I took 9,500 companies that are publicly traded, and I screened out the smaller companies. I only wanted large companies, $10 billion valuations, and I only wanted companies that were profitable. And we looked at just at those companies. There were 746 of them. And I compared the return on assets for those 746 companies, averaged about 8%. The return on assets for the tech leaders right now are 2, 3, 4 times. NVIDIA is 8 times, almost 9 times the average. It's a lot more than you're going to get on a savings account, let me tell you that, your return on assets. Profit margin, the average profitable company is a 14% profit margin. These companies have 2 or 3 or 4 or 5 times, in the case of NVIDIA, the profit margin of the average profitable company. What this means is these companies, when competition heats up, they have the ability to cut prices to compete. Right now, they don't have to cut prices. There's very little competition at this level, and others raking money in hand over fist. Speaking of money, look at the cash on hand that these companies have. This is huge. So even if they stub their toe on an AI project, they've got the deep pockets to recover. Even NVIDIA, the poorest of these 5, if I can use that term, $31 billion in cash can be considered poor. That $31 billion is enough money to buy any of the 95% of the stocks that are listed today. There's only about 5% of the companies they couldn't just walk in and pay cash for every share that's outstanding. That's a lot of power. And that's what the companies in 1999 and 2000 did not have. Will every one of the AI companies prosper? No. AI has been discussed as the fastest depreciating asset ever. There are companies who are spending many billions, hundreds of billions of dollars on huge data centers and other things that could be eclipsed by another technology or another process, okay? So these companies, in some respects, are rolling the dice because of the way that the AI bubble could shift. Many smaller companies especially will crash and burn as they miss their AI targets. How to protect yourself from owning one of those? My advice is follow the money. Look for companies that have strong revenues, companies that have profits, they're profitable right now. When I started in this business in the 1980s, I largely was a municipal bond salesman. And almost all the municipal bond defaults were from new enterprises that didn't yet have their profits. They had great projections, but they didn't have the profits yet. So look for profitable companies and look for deep pockets so that they can rebound if there's a change in the markets or some kind of an upset. The stock market correction Ryan mentioned began about a month ago, has caused many investors to start moving away from technology and AI stocks because they thought they were overvalued. They're looking for value in other places. An awful lot of money that's lost by searching for the next hot thing and distracting you from a mega trend like we've got right now, right in front of us. It's a money-making sweet spot of the market staring us right in the face. So I would encourage tech investors to stay the course and not miss the rest of the AI boom. Let me show you give you some perspective on historic booms. There are some things that really do change the world. Railroads changed the world in the 1800s. Automobiles and electrification in the early part of the last century. The internet 25, 35, 40 years ago changed our world. And I'm going to add AI to that list. It has the potential to change the world. AI has that big of an opportunity. So here at Shadow Ridge, I focus on companies that are profitable, that avoid heavy debt. So if they have a problem, they can pay their debts. Also that they're in some kind of a technological sweet spot. So if you want that kind of discipline and your portfolio, that's what you can get right here at Shadow Ridge.